So the question is, how does leverage impact the returns in a real estate investment? And so I'll try to keep it very high level, very general, but I'll give you a sense of how this works. So let's take the example of a $10 million real estate investment. Okay, $10 million. And there's two different ways that you could buy this $10 million investment. Way number one is 10 million of cash. That's cash. And the second way is 5 million of cash and 5 million of debt. So 50% leverage. And let's make an assumption that in 5 years, that $10 million piece of property is worth $12 million. Okay? So that's 12 million in 5 years, in year 5. So if this 10 million of cash produces, and let's just say there's no income in that 5 years, that 10 million of cash produces 12 million in year 5, that's a 20% total return in year 5, or on average, a 4% return per year, okay? And then if we have debt on the property, let's keep it very high level, this $2 million of profit, we sell it for 12 million in 5 years, you got to pay the $5 million of debt. Let's assume no amortization, keeping it very simple. We have a 40% return over 5 years, which is 8% return on average per year. So by adding debt, we're levering up, we're increasing the return to equity. Now, that's a very, very simple calculation. If it's an income producing property, then you can increase these returns by not just adding debt, but if you have cash flow that exceeds your interest rate or your debts, both interest rate and debt service, these returns will go up even higher. Now, what's the issue about adding leverage to a real estate investment? The issue is, as you lever up from 30% of the price to 50% to 60% to 80%, you'll increase the returns to your equity. That's the advantage of leverage. The disadvantage is that as you add leverage, your bank, your lender, has a first lien. And if the property does not pay its debt service, then the lender can foreclose upon the property and take over the property and destroy your equity. So that is the issue. As you lever up, what is the risk that the performance of the asset will be such that you cannot pay your debt service and therefore you risk losing all of your equity? That is what a sponsor, a real estate manager, needs to assess. In other words, what's the risk as you lever up? You're going to show on paper more return to your investors. But at some point, that risk gets so high that you don't want to jeopardize your equity. That's the challenge.